Indian stock market offers opportunities in various sectors, while the Forex market deals with currency trading. Each has its own risks and rewards. Let's explore our options and find out which one suits you best. First up, the Indian stock market. It's a fascinating world that can seem complex at first, but once you get the hang of it, it can be incredibly rewarding. Think of it like a giant marketplace where you can buy and sell pieces of companies called shares. Just like in a traditional market where goods are exchanged, here ownership in companies is traded. These companies are listed on stock exchanges like the Bombay Stock Exchange and the National Stock Exchange. These exchanges act as a platform where buyers and sellers meet to trade shares. The Indian stock market is well regulated by the Securities and Exchange Board of India, or SEBI. SEBI ensures that the market operates in a fair and transparent manner, protecting investors from fraud and malpractice. Think of SEBI as the police officer of the stock market, ensuring everything is fair and square. They keep an eye on all activities and make sure that everyone follows the rules. Now, the stock market has its own language. Terms like bull and bear markets, IPO, dividends, and market cap might sound confusing at first, but they are essential to understand. You'll hear words like bull market when prices are going up and bear market when they're going down. A bull market signifies optimism and growth, while a bear market indicates pessimism and decline. Don't worry, you'll learn all this slowly. The key is to start with the basics and gradually build your knowledge. Over time, you'll become more comfortable with the terminology and the mechanics of how the market works. The Indian stock market has a rich history, dating back to the 19th century. Understanding its evolution can give you a deeper appreciation of its current structure and operations. Today, technology has made it easier than ever to participate in the stock market. With just a smartphone, you can buy and sell shares, track your investments, and stay updated with market news. Staying informed is crucial. Financial news channels, market analysts, and online resources can provide valuable insights and help you make informed decisions. Remember, investing in the stock market is a journey. It's important to do your research, seek advice when needed, and stay patient. With time and experience, you'll become a more confident and knowledgeable investor. So why should you consider the Indian stock market? Firstly, it's familiar territory. You understand Indian companies, their products, and the economy. Secondly, SEBI's regulations make it a safer place to invest. Thirdly, the Indian stock market is generally less volatile compared to the Forex market. Volatility means how much the prices go up and down. Less volatility means less risk, which is good for beginners. However, the Indian stock market also has some drawbacks. The trading hours are limited, usually from 9:15 in the morning to 3:30 in the afternoon on weekdays. This means you can't buy or sell outside these hours. Also, liquidity, which means how easily you can buy or sell a share, can vary. Some shares are highly liquid, while others are not. Now, let's fly across the globe to the Forex market, short for foreign exchange. This is the largest and most liquid financial market in the world, where trillions of dollars are traded every single day. Unlike stock markets, which have a centralized exchange, the Forex market operates 24 hours a day, 5 days a week, across various financial centers around the world. This means that trading can happen at any time, making it a truly global and continuous market. Imagine a giant network connecting currencies from all over the world, like dollars, euros, yen, and of course our very own rupee. This network is made up of banks, financial institutions, corporations, governments, and individual traders. They all participate in the Forex market for various reasons, such as hedging against currency risk, speculating on currency movements, or facilitating international trade and investment. In the Forex market, you're basically buying one currency and selling another, hoping to make a profit from the changing exchange rates. For instance, if you think the euro will strengthen against the dollar, you would buy euros and sell dollars. If the euro does indeed appreciate, you can sell the euros back for a higher price, thus making a profit. This process is known as currency trading or Forex trading. For example, let's say you believe the rupee will become stronger against the dollar. This belief could be based on various factors such as economic data, political events, or market sentiment. By analyzing these factors, traders make informed decisions about which currencies to buy or sell. You can buy rupees by selling your dollars. This transaction is facilitated by a broker or a trading platform, which provides the necessary tools and resources to execute the trade. The exchange rate at which you buy or sell currencies is determined by the supply and demand in the market. If your prediction is right, and the rupee indeed gains value, you can buy back your dollars at a lower rate, making a profit. This profit is the difference between the buying and selling price, also known as the spread. Successful forex trading requires a good understanding of market trends, risk management, and a disciplined approach to trading. It's a dynamic and exciting market that offers numerous opportunities for those who are willing to learn and adapt. The forex market is like a 24/7 party. It's open round the clock 5 days a week. You can trade anytime from anywhere in the world. This flexibility is a major advantage. Secondly, the forex market is huge. It's the most liquid market globally, meaning you can easily buy or sell currencies without much difficulty. Lastly, the potential for profit is high in forex. Remember, high reward always comes with high risk. Now here comes the warning siren. The forex market is highly volatile. The prices of currencies fluctuate constantly, and even a small change can lead to significant gains or losses. This market is not for the faint-hearted. Also, forex trading is complex. It requires a deep understanding of economic indicators, global events, and trading strategies. Don't jump in without learning to swim first. Finally, leverage is a double-edged sword in forex. It allows you to control large sums of money with a small deposit. While this can amplify your profits, it can also magnify your losses, sometimes even exceeding your initial investment. Yikes! Just remember, it's a roller coaster ride. No matter which market you choose, remember that investing is a marathon, not a sprint. Start small, learn continuously, and don't put all your eggs in one basket. Diversification is key. And most importantly, seek advice from a financial advisor. They are like your financial gurus who can guide you towards the right path based on your goals and risk tolerance. So, are you ready to start your investing journey? I'm sure you'll make wise decisions and grow your wealth over time. Best of luck and happy investing.